Hello and welcome to Pro Trader Strategies Market Commentary for Friday, August the 4th, Unenjoyment Friday. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, now that we have all that out of the way, let's look at the economic data across the pond. Not a whole lot of real serious economic data. We did get Italian retail sales coming in better than expected at 1% versus the expected 0.6%. And we got German factory orders coming in at 1% versus the 0.6% expected. A little bit better on that front, and that is a month-over-month data. Here in the United States, like I mentioned, Unenjoyment Friday, it is the non-farm payrolls. We used to call it unenjoyment because it was the unemployment, little play on the word there. But at the end of the day, we got hourly earnings, month over month, 0.3% in line with expectations. The non-farm payrolls employment change came in at 209,000 hires, expected to be 182,000 hires, and they revised last month's number up a little bit there from 222,000 to 231,000. So really good economic data out of the United States on the unemployment. Unemployment rate remained unchanged at 4.3%. Now you'd think that number would come down, but when people start seeing a lot of people come or see a lot of people getting hired, a lot of people come off of the unemployment, or the discouraged workers have a tendency to come in and get hired and things of that nature. So that the unemployment rate, although a lot of people like to look at it, the real number to watch is the non-farm payrolls to see how the hiring is actually going along, and that number coming out quite nicely. That's driving crude oil higher today, going up, looking like it wants to go and test that $50 a barrel area again after being below this fib level. Not quite sure why this popped down here again, despite the fact that we're trading up here. It's a little bit odd. I'm not really sure how that happened. Yesterday it was right here on this fib line. We talked about that, it moving higher, meaning that price was being accepted at this $50 a level area, but crude oil's got to get that 200-day moving average in the rear view mirror before really any push to the upside. But as people start seeing these economic data points coming out, that's going to drive crude oil higher, as people will, drive and go on vacation and things of that nature. Also, on the flip side of that, with this good economic data, it kind of puts a damper on the gold bugs mantra to move higher. It's tested that 61 fib level a couple of times, and now moving back down to the 50 fib is probably the next target. That's where the point of control, where the most time and volume basically has been spent. So look for gold to be going down to that 1250 area pretty shortly, I would have to think. But having said that, not a whole lot going. Oh, sorry, the bonds. Forgot about the bonds. Bonds down down a point today, basically engulfing yesterday's rally. Overall market should come back down here, I would expect, to the point of control as well. So look for bonds to be trading into the 152 handle in the next week or so, probably. The economic data just being too good for it to not really want to come off a little bit. Right now, bonds 31 bid at even. See that 31 trade. Anyway, no surprise that the Dow Jones Industrial Average made it a new historical high today. Opened up on a bit of a gap on that number. Still up 20 points on the day, but it looks like a negative day, but it's because it opened a lot higher on that good non-farm payroll number. The NASDAQ up 12 points on the day. This includes overnight, so it would have basically looked about the same, where it kind of pushed higher on the open right on that data point. But the NASDAQ pushing higher, not quite engulfing yesterday's down move, but it's still pretty robust. Just a real quiet day, it seems like. I'm surprised. Usually we're going to get a little bit more volatility in the market, or at least a little bit more action. Seems like people saw that unemployment number steady as she goes, and it's a rush to the Hamptons early on a Friday. Late summer, people probably trying to get in the last couple of days in the Hampton, or last couple of weekends in the Hamptons. E-mini S&Ps just up over a point. Again, tight range. We think we'd get a little bit more movement on those good economic data to the upside, but we're not really seeing that so far. But the E-mini S&Ps up on the day, and you can see the volume just really low, as we would expect on a Friday in the summer. But all right, on to the couple of things that let's do the E-mini S&P 30-minute chart, right? I'm trying to get ahead of myself, I guess. As you can see, we're up a little bit higher, pushed to the highs of the day on the non-farm payrolls number. Given a bit back, but at the end of the day, I don't see why it would be in negative territory given the economic data points we've been seeing. So I think it's going to continue to kind of grind a little bit higher, I should say. All right, XLK, technology sector. If you remember, it kind of got back into this upward trending area, had high implied volatility. I decided to jump on it, thought it was a little bit overdone. We were seeing the Dow Jones kind of push higher. NASDAQ was dragging. I've talked about a sector rotation out of tech and into the blue chips. I think that you're going to probably see a little bit of that come back again, where the Dow stocks, the blue chips, are going to give up a little bit to technology, especially with the economic data points. And XLK being the technology ETF, I thought it would go a little bit higher and stay within this trend channel. So if you remember, I did a couple of trades in here with XLK, and I did them in August and in September. I've gotten out of my August, but the September is still working. Talked about this yesterday as well. Wasn't able to get out of them. Actually waiting that one extra day gave me the opportunity, and I had on the August 56 puts. And originally I sold them for 32 cents, bought them back for 14 today. Yesterday I was working for 15 cents, and overnight I got a extra penny from them. Thank you. The XLK September 54 puts that I originally sold for just over 50 cents. I'm working a 23 cent bid in there and have not gotten hit. It's trading around 25, 26. So those have a little bit more room to the downside. As you can see, I really wanted to get out of those 56s because, the 56 puts, because they're a little bit closer. 54 puts are, way down here. So I'm not really worried about those at all. Just trying to stay mechanical at the 50% of my max profit on those. But with today's up move, the economic data, I'm going to squeeze a couple extra pennies out of those, I think. All right, and then on to Philip Morris. If you remember yesterday, I talked about Philip Morris. I did a strangle in there. I was trying to look for a couple of trades to put into my margin account, and this kind of segues into today's webinar. Yesterday I did the strangle. That has a little bit more risk, and with margin account you can do that, but with the IRAs and things like that, and if you're not really comfortable with taking that kind of risk on, like with the strangle, where it's kind of naked on both ends, you have unlimited risk on either side. It didn't really work with the iron condor. That was a little bit tight for something like Philip Morris, even though it had high implied volatility. Couldn't get those far enough out, so I went with the strangle. But then I started thinking, this would be a good strategy to put into my IRA. So I looked at a couple of different things, and lo and behold, the long call butterfly fit perfectly for it. As a matter of fact, so I went in there and did the September, and I sold 2 of the 115 puts, and then defined that risk by buying the 110 puts to the downside, 5 ticks wide, and then the 120 puts to the upside to create that butterfly, the long put butterfly, and I paid $1.60 for it. So Nice risk reward on that. I get about $3.40 if we kind of stay within those wings in a sense. If it basically pins right here at 115, that would be the perfect case scenario, which would be, just slightly below where we're trading right now. But if it kind of bounces around in here, we get the volatility contraction. That should work. And as you can see, volatility is starting to contract rather quickly. So, that's going to help out my strangle a lot faster than probably this long call butterfly. But at the end of the day, you can't really put those naked strategies in an IRA, and it doesn't work with an iron condor necessarily. So the long call butterfly fit all my rules and everything else that I'm going to talk about in today's webinar. So go to protraderstrategies.com. Make sure you sign up for that. Get in there early because we've been filling up that classroom almost as soon as I open up the room. So get in there early, get in the waiting line, I guess, and hopefully we can see you all there and participate in that. I think you'll get a little bit more out of it if you're in the webinar yourself, because it makes it much easier for you to ask questions and get that give and take. All right, so go to protraderstrategies.com, sign up for that, and if you can't take that, take it easy.